Welcome to Bloomberg Markets. I'm Shonali Bassick, and investors are still trying to come to grips with two big data points today. That's hotter than expected inflation and a slowdown in the labor market. Let's get a check on these markets, see how they're reacting throughout the day now. You have the S&P 500 roughly flat, same too for the NASDAQ 100. A little bit of green on the screen, but not by much. The 2-year, now standing at 396, has been an interesting whipsaw this morning, and the 10-year now at 407, almost 408. The 10-year roughly flat, but really still some movement in the 2-year. Of course, we hit above 4% really just days ago. Now some midday movers on the equity side. Bloomberg's Abigail Doolittle joins us now.
Well, one stock that's helping the S&P 500 and the NASDAQ 100, Shonali, for sure, is Amazon, up about 0.9%. This after their Prime Day event, 2 days, of course. And they're saying it's the biggest October selling event that they've had. More shoppers since last year. And it's been a rocky week for Amazon, though, because earlier this week, of course, downgraded by Bernstein on concerns that they might be relying too much on the cloud, but it does seem that their e-commerce business is doing well. Turning to the shares of Tesla, today is the big day. They will be unveiling the robo-taxi, and shares have actually flipped higher. They had been lower earlier today, as you can see, but right now up ever so slightly. Lots of pressure to see their fully self-driving vehicle, and some analysts saying that this is going to be one of the big growth drivers ahead, but will it prove to be what folks are expecting, given the fact that this company has such a valuation premium over, say, the likes of Ford and GM. And then finally, if we take a look at the shares of Domino's, they've been all over the map on the day. They reported a quarter that was fine, but the guidance, so at this point, you can see earlier today down sharply, then up right now, up just slightly. The quarter was fine. It was really the view they cut, including store growth. Some of this, of course, Shonali, having to do with inflation as consumers cut back their eating out habits.
Abby, thank you so much. We're going to go back now to today's economic data. Earlier, we caught up with PGIM's Greg Peters, who told us what is more important to him, inflation or labor.
I think what's continued to be really important is the labor market. I think inflation is still last year's story. Yes, there was an upside surprise there, but at the end of the day, it's about labor, labor, and labor.
For his take on the jobs numbers today and, of course, the inflation print as well, we are joined now by Mike Contopoulos, Director of Fixed Income at Bernstein Advisors. It's interesting. What was more important to you? You saw that whipsaw in the bond market this morning. Yields up after the inflation print, yields right back down after jobs. What's more important?
I tend to agree with Greg. I think jobs are a bit more important here to the Fed. But the one thing I would say is that jobs aren't bad. Claims data came in a little bit weaker today, certainly, but overall, the jobs picture is pretty healthy. So I'm not sure if either are really that much of a concern at the moment, or at least should be that much of a concern.
So at what point do they become a concern? Because do you see a scenario where the Fed would have to deal with kind of sticky inflation as well as weakening labor at the same time?
Yeah, I don't really buy into the idea that labor is weakening all that much, quite frankly. We have a pretty healthy jobs market, and I think what's happening is the Fed is confusing a bit of cause and effect of having tight monetary policy and restrictive monetary policy with really a coincidence. And I don't actually think that, the Fed funds rate up where it is today is causing unemployment to accelerate. I think this is just a normalization of post-COVID distortions. In reality, labor market's pretty strong. Earnings growth is accelerating, and when you have strong earnings and a reasonably strong economy, labor shouldn't really be that much of a concern. And so I kind of take a very different view, I think, than most, and it's that labor is actually stronger than what people realize.
It's interesting. You have that bid in that bond market today, but you also have kind of a cross current where you see swaps pricing in less than one cut in the next meeting for the Fed. What do you make of that?
Yeah, I think that the swaps market actually probably has it right. I think, when you look out over the next, through the rest of 2024 and even into 2025, I think the market is largely overpricing the amount of cuts that we'll ultimately see. And I could easily see a case where, the Fed has to skip November because of slightly elevated inflation and reasonable economic growth and a strong labor market, and they actually end up skipping November. So that doesn't surprise me one bit. I actually tend to agree with it. I think the bigger thing that we'll be discussing in another 3 to 6 months is not only is the Fed going to pause more frequently, but is there a need maybe even to tighten policy again? And nobody's really talking about this, and it is a risk.
So what do you mean by tighten policy here? Because something we've been talking more and more about is this idea that the Fed's balance sheet is still above $7 trillion. But the last time you saw them really try to tighten, you got something kind of close to a taper. Is that fair? A tantrum?
Yeah, it is. I mean, I think the balance sheet is so large and is running off with such efficiency that it's not actually creating huge problems in the market. I think, at the end of the day, there's just so much liquidity still out there. And it's that fiscal and monetary liquidity that's still out there that I think, really sort of will drive not only the markets, but the economy. And that in the backdrop, you have, as Janet Yellen said, I think it was Yellen, maybe it was Bernanke, you'll probably remember better than I, but it's like watching paint dry, right? And I kind of think that's the way the balance sheet runoff is going to be for some time because of all this excess liquidity in the markets, in the economy. The runoff isn't really going to have a huge effect.
Okay, so you said they might skip in November, but what does that mean for December? Do you think that there's a chance that they don't have to cut more this year at all?
Well, I think there's certainly a chance. Just given the bias of the committee and certainly Chair Powell, I think his bias is obviously to cut interest rates. And so I would expect that they will try to get another cut in this year. And listen, they may cut twice. And if they do cut twice, I think that's going to be a mistake. So it's not necessarily that they won't do it. The Fed will do what they want to do. But as you see where the puck is going rather than maybe where it's been, and of course the Fed's looking at where it's been, not where it's going, I think you could make an argument that if they cut in November, if they cut in December, it will be a mistake. So I could absolutely see them not cutting at all for the rest of this year. And I could see them cutting another 25 at each meeting. Either way, I think what it will be is the end result will likely be what we saw 2 weeks ago, that by loosening policy into a reasonable economic environment, you actually get longer term yields up, inflation and growth expectations accelerate, a bear steepening of the yield curve, and that might surprise some people that rates could get back up towards 4.25 or 4.5.
Now, how do you position in the bond market for the scenarios that you are laying out? You see that bid today, as we've been talking about, but would you buy at these levels?
No, we actually, right before the Fed meeting, we reduced our duration at RBA in anticipation of actually the Fed cut and what that meant for longer term yields and inflation expectations and future economic growth to the upside. And so we reduced duration right before the Fed meeting. So we think clients should be underweight interest rate risk here relative to the broad market. That doesn't mean don't own any treasuries or interest rate risk. It just means be a little bit underweight relative to the broad market. We also think it's really, investors need to be very, very careful with just traditional fixed rate, investment grade, and high yield debt. The high yield market, according to the Bloomberg High Yield Index, currently trades at roughly 290 basis points. The investment grade market currently trades in the low 80s. When you get to these levels on corporate debt, you're not getting compensated for interest rate risk. So we prefer to get our cyclicality within fixed income from other areas of the fixed income market, namely CLOs at the moment.
So it's fascinating. How much risk are you really willing to take on? It seems that many investors are pretty sanguine right now about what the economy looks like, but what's the tail risk here?
Well, I think there's certainly two tail risks that are the obvious ones. Tail risk number one is that what I mentioned earlier is wrong, and we're not seeing normalization, but instead, we are seeing the beginnings of a meaningful slowdown in labor and the economy, and that you have a hard landing. That's obviously tail risk number one. And tail risk number two is the exact opposite, that the Fed, by cutting interest rates with so much liquidity and strong earnings, et cetera, is really about to ignite a growth boom. And there's a risk to that. There's certainly risk to that from a fixed income markets perspective because it would mean significantly higher rates, higher volatility. That higher volatility would not only feed through to treasuries, but other areas of the fixed income market. And so I do think there are two very discrete risks out there. Our bias is actually there's a greater risk to that upside growth and inflation narrative. And I think that's the one that's probably being most underappreciated by markets at the moment.
Real quick here, favorite trade at this juncture?
Yeah, we really like triple B CLOs is one of our favorite positions at the moment. Reasonable spread, fantastic yield, is sensitive to strong earnings growth, and a Fed that's going to be less restrictive than what the market expects. So we'll go down in quality a little bit and get our credit risk from the triple B CLO market.
So great to have you here in studio. Of
being
course,
here.
that is Mike Contopoulos from Bernstein Advisors. He's the director of fixed income there. Now, coming up, one estimate puts the damages and losses from Hurricane Milton between $60 billion and $75 billion. We're going to discuss the latest updates from the massive storm that hit Florida last night and into the morning. This is Bloomberg. Now, I want to bring you some breaking news here on TD Bank. You see shares dropping on headlines that two bank units of TD Bank are to plead guilty in a money laundering case. Now, we do expect more headlines coming out of the Fed, the OCC, and from TD Bank. We are waiting to hear from them. But initially, we do know that they are expected to plead guilty, of course, in a case that has been an overhang for this bank all year. You are seeing TD shares now down more than 3% this year. Now, switching gears, Hurricane Milton making landfall in Florida overnight, leaving a path of flooding and power outages from the Gulf Coast to the Atlantic Ocean. Florida Governor Ron DeSantis saying it could have been worse.
The storm was significant, but thankfully this was not the worst case scenario. The storm did weaken before landfall, and the storm surge, as initially reported, has not been as significant overall as what was observed for Hurricane Helene.
Now, for more on this, let's bring in Bloomberg reporter Josh Saul. You know, it could have been worse perhaps, but the fact that we've had back-to-back hurricanes, it's still pretty bad. What are we seeing?
That's right, Sonali. The storm surge being not as high as we thought it would be was great. I mean, it basically went from 2 of me to 1 of me. So that's a lot less water moving through and hurting homes and hurting people, but still a lot of damage. And the fact that Helene came through so recently meant that the soil was waterlogged. That means trees are weaker and are more likely to fall over and knock down power lines. It means that there was a lot more debris around. Some of the utilities in the state have been telling me that with so much debris, which everything from boards to construction dumpsters, just lots of stuff all around, that means that when those hurricane force winds hit, they pick that stuff up, they whip it around, they cause a lot of damage, and they smash it into power lines, which causes even more power outages.
Well, give us a scale of those outages. I mean, how many people are being left without power? What is the devastation?
Right now, there's 3 million customers, so that's businesses and homes. So that's a lot more people because a home can have multiple people. But 3 million customers have no electricity, which obviously is really, really difficult. And that number is going to fluctuate. And some utilities I've spoken to this morning said it even will go up. The storm is still hitting eastern parts of the state. And also, as people return to their homes, they report to the utility, hey, my power's out, which will cause those numbers to go up. But at the same time, the utilities, the power companies have begun damage assessments and have begun flipping power back on. So the number will also be going down throughout the day and in the weeks to come.
You know, really quickly here, too, we have Chuck Watson at Enki Research, followed this for a very long time, said losses between tornadoes and other damages could be between $60 and $75 billion. Given that the hurricane is less bad than what is expected, do you think it could be less than that?
There's a lot of assessments to do, but from orange groves to homes, a huge amount of damage from this and coming right on the heels of Helene. So we'll see.
Josh, we thank you so very much. Of course, that is Josh Saul for Bloomberg News. Now coming up, Money Undercover's weekly segment is back. We're going to take a look at the IPO market with Andrea Auerbach of Cambridge Associates. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. It's time now for Bloomberg Money Undercover, our weekly segment where we cover unique challenges and opportunities facing alternative investments. This week, we heard from both Citadel Securities CEO Peng Zhao and JP Morgan's Jamie Dimon about the roadblocks for the current IPO market.
The negative side effects of being a public company as a result of regulation like the ones you are mentioning that's happening to go right now, it's giving people longer and longer pause. Right? Until that changes, it probably also means next time when you try to ask me, when you not try. When you ask me whether we're going IPO or not, the answer will continue to be no.
In the United States, we've made it hard to go public. We've eliminated research on smaller companies. The costs are much higher. Those litigation expenses are higher. Filing with the SEC is higher. So I think it would be really incumbent upon us to try to make it easier and cheaper to go public.
Now, Diamond also said that it's partly that private companies are hoping for higher valuations than the market will give them. Either way, it raises a question about how private equity can become appealing again without a robust market for exits. Bloomberg surveillance anchor Lisa Abramowicz joins us for that with a guest on this issue.
Thank you so much, Shonali. I am here with Andrea Auerbach. She is the global head of private investments at Cambridge Associates. It serves around 580 endowments and foundation clients, plus hundreds of family offices and other institutional investors around the world. Andrea, it is wonderful to see you in person. It's been too long. I want to start there. How difficult has it made private equity as an asset class for some of these institutions, given that you're not seeing the exits that we once had?
Yeah, we are definitely in a distribution drought, and I think the dam of pent-up exits that endowments, foundations, all of our clients, pensions, et cetera, have been waiting for. I think we counted the tally about 800 billion of exits that should have happened by now, but haven't. And that has definitely fed into some stress for institutions that were relying on those distributions to fuel their activities, philanthropically or otherwise.
How much do you attribute this to a regulatory framework that makes it more expensive to IPO versus there are a lot of companies in the private sphere that have inflated expectations for what they could get in the public markets?
Yeah, well, that's the thing. The private markets are very deep and dense, right? And so the information that we have at Cambridge Associates, there's 17,000 buyouts, venture capital-backed companies that we track alone, right? And let's say we're covering a big swath of the market. There's an average of how many IPOs in this country a year? Maybe 200. So most of the exits that we expect to see in the private markets will likely go by M&A. And as we said, a lot of the transaction activity has slowed basically to a trickle still. And we are waiting. As I mentioned, those pent-up exits, we're like, time's ticking here.
Well, it raises this question, especially when you talk about endowments and other foundations, institutions. Do they find private equity to be a less attractive asset class because there are less reliable distributions, as has been proven out over the past few years?
Lisa, I guess a couple of things, right? You've got to maintain a perspective, and I think what we've been saying at Cambridge, as it relates to the private markets, is you need to focus on the compass, not the clock, right? So over the last year or 2 years, the private markets have been very quiet. Fundraising is down, distributions are down, as we've talked about. 1 year performance in the private markets, which is not a good metric for measuring private market performance, also kind of anemic, right? And so long-standing, experienced private markets investors, they look out. They're like, well, on a 5-year or a 10-year basis, the private markets have outperformed publics 300 to 400 basis points, and distributions will resume. They have to. This is not a roach motel for capital. Eventually, the managers who have that money invested have to realize it and get that capital back to their investors.
Given that patience that you kind of have to have through a cycle like this, does it make sense to open up to retail investors who could potentially pull their money on a more regular schedule?
That's a really interesting question for the GPs, the general partners that are raising these funds. And so as fundraising at the institutional level may have gotten a little quieter as those institutions are waiting for capital to come back before reinvesting into the asset class, as you've noticed and we've noticed, there's been an expansion of private fund offerings, other forms of accessing a broader swath of retail investors. And that's definitely bringing capital into the space.
I wonder, though, if it also is making it a bit more risky for some of the other institutions, just because you don't want to have to sell when you don't want to. You don't want to have to make an exit at an inauspicious time. I mean, I guess just on a broader level, when you look at the different asset classes within private markets, private equity, private credit, infrastructure, some of the asset-based lending, has private equity become less attractive more broadly as a slice of that sort of alternative allocation just because of some of these issues?
Yeah, I mean, these are temporal in nature, right? So we know that private equity, the average hold period for a private investment is 7 years. So if you're judging anything on a 1 or 2 year period, you're not being patient enough. And the long-term returns of the private markets do tend to outperform public market options because the capital has a longer time to do its work and develop that kind of value that's coming back out. So really it's about patience and also understanding who you've invested with and if they are capable of delivering the kinds of returns that we're paying them for.
Do you find that given where interest rates are now, the fact that you could actually get 5% without taking much risk, the fact that suddenly there are returns to be had, it isn't sort of this race to nowhere and this sort of ZERP world forever, has that changed the appetite for some more alternative products? Does that serve a different role in some of the institutional portfolios?
I mean, absolutely. With the end of ZERP and the rise of interest rates, private credit has blossomed, right? There's a lot of capital in private credit right now. The one-year returns for private credit are better than the one-year returns for private equity and venture capital. But again, when you start moving out into a 5-year period or a 10-year period, private equity and venture tend to start to crest and deliver the kinds of returns you expect. But private credit, make no mistake, has definitely been thriving in this environment.
I wonder if it's going to be the same this time around. And I hate saying this time is different just because, you know, you always end up getting burned when you say that. But because there has been so much money that has flooded into these areas, because there has been such a race to get deals done, do you think that there's been some cannibalization from the quality of some of these deals?
Right. When I think about the amount of capital that's come into the space, and keep in mind, you know, dry powder, the snowpack of dry powder is at an all-time high right now. But the vast majority of that capital is sitting in funds of $5 billion or more, right? And so one of the things that we're always reminding our investors at Cambridge Associates, our clients, is that this is not a monolithic space. While a lot of the capital may be going to the very top of the market, there are thousands upon thousands of managers doing their thing in the lower middle market, in the growth equity market, in secondaries, which has also been blossoming lately this year and last year. And so it's a broad and diverse space. You got to pick your spots. You have to pick your spots.
Just quickly, how much have you found that sort of the appetite for risk has been increasing, decreasing, or staying about the same?
Yeah. Well, if you look back, and we chatted about this, I think last year, we had a chance to have this conversation. In 21-22, when we still were in ZERP, there was a big risk-on element. Now with the 50 basis point rate cut, does it feel like there might be a little loosening of risk, a willingness to take more on? Well, we're seeing that from a leverage standpoint, right? Spreads are tightening, there's a little more availability, covenants are loosening a little bit. That may release some of that pent-up exit energy that we are watching right now. So maybe.
Andrea Auerbach, thank you so much. That was Andrea Auerbach of Cambridge Associates.
Coming up, more markets ahead. This is Bloomberg. Welcome to Bloomberg Markets. I'm Sonali Basak. Let's get a quick check on these markets. Pretty flat day here. You have the S&P 500 trying to turn green. Not doing a very good job there, though. The NASDAQ 100 also pretty unchanged here, but barely in the green. Now, you have the 2-year yield, some buying in the bond market, at least at the short end of the curve, but only now about a 6 basis point change here in the 2-year yield. You have it standing around 396. I've been told that the smart people go out 3 basis points. You have the 10-year now at 407. Some midday movers on the equity side. Here's Bloomberg's Abigail Doolittle.
Well, starting off with the shares of Delta Airlines, Sonali, we're seeing really nice recovery. Earlier today, shares had been down sharply on a disappointing fourth quarter view. Now the stock down on the day just about 0.3% or thereabouts. And the fourth quarter guide, it was light. It came in light, in part, interestingly, because of the expectation of less travel around the election. And then, of course, there was that third quarter technology glitch. It cost them $388 million and 45 cents per share. They still want payback, but the company, Crowdstrike, it in fact is higher today. Interestingly enough, up 3.5%. They have struck a security deal with Plurilock. In addition, RBC is saying that Crowdstrike right now is one of the better software ideas out there. And then finally, one stock up for a second day, in fact, really soaring here, is Donald Trump had DJT, Trump Media and Entertainment, up 15.4%. It's incredible, Sonali. So right now we have this stock higher as Donald Trump is saying that Americans who are living abroad who are being taxed twice, he wants to eliminate that. But what's incredible, that plan may be attractive to those living abroad, but what's incredible, this stock since late September, it's up more than 100%. This, of course, ahead of the election. And I also just looked at the betting odds between Kamala Harris, VP Harris, and the former president. And now Donald Trump has pulled ahead ever so slightly. So it's going to be a nail biter right down to the very end.
Abigail, thank you so very much for keeping an eye on all of it. We're going to now go from the public to the private. We are joined now by CAIS founder and CEO Matt Brown. The company's platform supports over 50,000 advisors who oversee more than $4.5 trillion in network assets. And Matt, you know, it's interesting. You have a conference next week. I will be at it. I'll be interviewing the CEO of CEO of Apollo, Mark Rowan. One big trend at Apollo and others is that wealth channel. It's a big growth area that they're looking at. So how hard is that to tap? Because these are assets that have not traditionally been very easy to buy.
Well, thanks, Sheila. Great to be here again. You hit on something that I think is a major trend that's happening, which is that the alternative asset management community is really focused on serving the wealth management community now. And so what they're doing is they're really investing in teams. They're looking at different product structures, which we can talk about, marketing. In many ways, what they're doing is copying the playbook of the mutual fund industry and really looking how to serve the advisor better and deliver them the right products to enhance portfolio performance.
It's interesting. That's something we know Franklin Templeton, CEO, has talked about a lot, you know, kind of a godfather or grandfather of the mutual fund industry here, also looking at private assets. You know, one interesting structure is that push by Apollo and State Street to try to put private credit into an ETF. Is there more where that came from?
I think you're just beginning to see it. The traditional asset community and the alternative asset community are really now coming together as one. You look at that traditional 60-40 portfolio, which is now turning into a 50-30. 20 being, of course, alternative investments. But now it really becomes the question of how does that happen? And how do you actually get all three in one portfolio? And there's a few ways to do it. What you just saw, that example, is creating a product structure that actually blends traditional and alternatives. Technology also plays a big role in that as you allocate to alternatives. But make no mistake, it's happening fast. And model portfolios that now are comprehensive and include alts alongside of traditionals are definitely the way forward.
Now, here's something I don't understand. So that ETF has not been approved by regulators yet, so we haven't seen it. But this has been a couple of years where we've actually seen hiccups in the structure. When you think about interval funds, it's semi-liquid, right? And now you're trying to introduce more liquidity to this market. But is there a significant mismatch here between the assets and the liabilities?
I think the beginning of all this has to start with advisor education and making sure that advisors and their clients understand exactly what the liquidity parameters are for the investments that they're making. At CAIS, we've invested a tremendous amount in the front end of our technology platform to make sure advisors fully understand the funds that are being offered and how they fit into a broader portfolio. But we do keep an eye on it, and it is something that we do want to take a look at. Is the fund structure and the liquidity terms matching the underlying investments?
Well, one thing I'm also very curious about is who this is really made for. It used to be that you had to have a lot of money to be able to invest in alternative assets. The ticket sizes would be north of $250,000 per investment, and it seems to be lowering very meaningfully. How much can you put into a fund these days in one sweep?
Well, the fund structures now allow as little as $50,000, $25,000, in some cases potentially even less. But it's less about the amount and more about what the net worth and the risk tolerance of the end client is. I'd argue that the traditional asset community, though not deemed as risky as alternatives, does present much more risk. I mean, the beta that you're seeing in equities and fixed income. Alternatives have a great way to deliver non-correlated returns and level out portfolio performance. And you're seeing that, and that's why there's such a huge push, not just Apollo, but really every large asset management firm in the alt space trying to figure out the best way to pair traditional and alternatives.
Yeah, Ares, Blackstone, certainly large wealth management forces these days. When you think about how wonky some of these assets are getting. You know, it's not just private credit or private equity. People are thinking about how to invest in alternatives as out there as sports, right? I mean, what are some of these new hot asset classes that are newer to these investors that might not immediately meet the eye?
Well, as a platform for alternative investments, we do have a nice seat to see all the new ideas. And we can't ignore this big trend of sports, media, and entertainment assets that were largely reserved for the super high net worth individual, now being democratized and made available to average investors. It's an amazing asset class. I mean, just take sports. You look at the values of some of these sports teams, NFL, NBA, et cetera, and the media rights value that they have. I think the stat that I just read was that 48 out of the 50 top watched television shows were live sports. So live entertainment, live sports are dominating, and the media contracts they're able to do really are adding huge franchise value to these sports teams.
So it's interesting because it's not just sports, it's artwork, for example, as well. Yeah. There are very interesting assets that have already been private, but this week alone, we've heard from Jamie Dimon, the Citadel Securities CEO, all of these large Wall Street executives saying that they have had this frustration that the public markets have not been more open to companies. How does that problem play out among investors that use your platform?
Well, because we focus on private markets, I think you're seeing more and more great companies stay private. And that's one of the reasons, anyway, that the private markets are growing so fast. At our summit that you mentioned earlier, you know, we've collected over 600 financial advisors and over 60 to 70 of the leading private markets managers. And they're really coming together to talk about questions just like that. What are the future of private markets? What if the IPO market isn't really that robust? And they're asking themselves, as CEOs of companies, do we need to go public? Are there other ways to get liquidity for shareholders and have exits? So it's going to be a fascinating summit, and I'm very happy you're joining.
Well, for the private equity piece of this, because if you're not going public, then perhaps private equity has more deal opportunity, but it's not an asset class that has been doing that well lately. What is the interest of your clients to be in that world?
Yeah, private equity and the word lately often don't go together. I think anyone who's investing in private equity right now is doing it for, you know, the 5 and 10 year horizon. You know, markets go up and down in cycles, but the historical returns of private equity speak for themselves. I think the market volatility of traditional asset classes right now are giving a lot of people some anxiety. We have an election coming up. We have kind of global instability. So private markets, and just from the view from the volumes that are coming across our platform into private credit, into private equity, I think financial advisors, which are our clients, are really voting with their dollars and where they think the right place for their clients' capital is.
Matt, we thank you so very much. Of course, that is Matt Brown. He is the CEO and founder of CAIS. Now, coming up, a live look on the ground in Florida as Hurricane Milton leaves behind a path of destruction. That's next. This is Bloomberg. This is Bloomberg Markets. I'm Sonali Basak. Now we're following the latest updates in the wake of Hurricane Milton, which has left a path of destruction across Florida. ABC News correspondent Jaclyn Lee is live on the ground in St. Petersburg in front of Tropicana Field, which is one of the most visible structures damaged. Jaclyn.
Hey, Sonali, yeah, you can see the devastation behind me. So what's interesting about this is the roof, it was made of fiberglass, and it was meant to withstand wind gusts up to 115 miles an hour. Now, our meteorologists confirmed the St. Petersburg area received wind gusts of about 101 miles an hour, just showing you just how powerful Hurricane Milton was. Now, we heard earlier from Florida Governor Ron DeSantis. He said that on Wednesdays, when they decided to move out the first responders, initially ahead of Hurricane Milton's landfall, this was going to be a base camp. 10,000 first responders and operations were going to be based here at Tropicana Field. But once they saw the forecast, they moved them all out on Wednesday. And thank goodness they did, because you can see just that devastation here. Sonali.
How do residents feel?
So we just spoke with a woman who lives right across the street, and she actually lives on the 8th floor. So she decided not to evacuate, but she said last night she was terrified. She said it sounded like a freight train with the wind and the rain just lashing her windows. She said she and her friend, they actually rushed into the stairwell on the 14th floor and stayed there all night long because they thought that they were going to die. She said she dealt with flooding in her apartment. She said she's never had to deal with something at this level before in all of her time living here in Florida. So she said she was just terrified, but overall she's very glad that she made it to the other side. Shonali.
Jaclyn, we really appreciate you joining us. That is ABC News correspondent Jaclyn Lee. I want to now focus on the airlines because as of 11 a.m. New York time, more than 2,230 flights around the United States were canceled, most of them serving Orlando, Tampa, Palm Beach, Miami, and Southwest Florida International. For more of this, plus Delta earnings we got this morning, we are joined by Sheila Kahyaoglu. She covers aerospace as a managing director in equity research over at Jefferies. You know, let's just talk about these cancellations and delays, because between the hurricanes, the weather that we have seen across the country, and then also the outage that we saw, frankly, a couple months ago. How much disruption is there right now to airline systems, and what's the economic impact?
I think with Hurricane Milton, it's clearly a tough situation. You know, the most exposed airlines are the low-cost carriers. Frontier, they have about 50% of their capacity goes into the Florida market, believe it or not. So that's one I would keep an eye out on, as well as Spirit Airlines. So the network carriers, American, Delta, United, they have about 5% of ASMs into the Florida market, so much more diversified. Delta was asked this morning what their profit impact would be. It's too early to call, depending on how long the cancellations last. So for now, I mean, it's clearly a very catastrophic event. But from an airline perspective, it's taking out capacity out of a market that we've seen yields depressed in.
Well, it's interesting. I do fully appreciate that it's very early and hard to calculate the economic impact. But what would kind of go behind your thinking there of that analysis?
It's hard to tell. You know, for the network carriers, it's actually not meaningful. What we've seen is capacity come out of the market. First half capacity grew 6 to 7% year over year. We're seeing the exit rate for the end of the year at 1 to 2%. When I was talking to the Delta CFO, it's even lower than we expected. We thought we would exit the year up 3%. So it's just the market being more rationalized. So that's how we're thinking about it. You know, hurricanes and events of the sort, to put in perspective, the Paris Olympics on Delta had about 150 million EBIT impact. Now they're calling out the election impact, although I am traveling 3 times that week, so I don't buy Delta's excuse, but they're saying people won't travel the week of the election. So they're calling that out more so than the hurricane.
Well, let's talk more about Delta, because you are seeing the stock now down about 0.3%. It's still a stock that's been up more than 25% this year. What did you make of the results?
They were okay. To be honest, I read it more positively for United. Just where they're seeing their strength in the corporate market, they're seeing the coastal hubs come back. That's where United is positioned more so. Secondly, pricing is improving a little bit, but you're really seeing a discrepancy. Main cabin down 5, premium up 4. So a 9-point discrepancy. Historically, it's been about 5 points. So we're seeing that premium cabin continue to yield better results. And then, of course, cargo remains strong. So a lot of it bodes well. And obviously, Crowdstrike impacted Delta results a little bit, but bodes well, like in terms of United's best positioning for them.
Well, fascinating. When you were talking about that discrepancy between kind of the more expensive seats and the regular way seats, you know, how does that compare with what we've seen elsewhere?
We're seeing everybody dive into the premium market. They know that's where they're getting the pricing premium. Can you imagine main cabin seats are down 5% year over year in terms of prices? Nothing in the world is down 5%. It's just phenomenal. And why you're seeing that is so much low-cost capacity, low-cost carriers coming into that market. And so it's driving down yields. So everybody's going premium, whether it's Delta and United that are the premium leaders, but also Southwest. We saw that at their analyst day. In fact, we just upgraded Southwest from an underperform rating to a hold rating because we think some of their extra legroom strategy, even though it's only 3 inches, will yield some sort of price premium. It won't yield what, you know, Southwest is telling us, but they'll get some sort of price premium for it.
Fascinating. How premium, right? Because if everyone is diving in, at what point does that start to put some pricing pressure on the luxury markets?
Well, that's what we're wondering. And of course, if main cabin improves, it's not as much of a margin improvement to an airline like Delta, whereas if premium continues to expand. So what is the ceiling on premium? How many Sky Clubs can you have? And I don't want to misquote how many Delta has, but, you know, they are upping the premium experience. It's not only about extra legroom where you're in exit 20 like Southwest. I agree with them. It's about the Sky Clubs. It's about the overall experience. The United app, I think, is like a leading indicator for how good United is. It's really easy to rebook. Their chat tools are great. So it's about the overall experience, not just 3 inches on a flight.
That rebooking idea, I'm sure with everything that's going on, is an important service here. I mean, I fly economy largely, so I actually don't know how much these flights go for.
CPI prices just came out today, although it's not, some people say it's not a lead indicator. We use average pricing about $300 a ticket in the U.S. domestic market.
But that's economy.
That's economy fares. It depends. It depends where you go, and you really need to know the route structure. I think when you fly United and Delta, you pay a price premium to fly New York to San Francisco or New York to
What's like a fair price for a luxury seat or luxury?
To be honest, I don't think about the pricing. I think about what kind of aircraft am I flying.
Okay.
Am I flying a knackered 757? That might be delayed because they need some maintenance, or am I flying a brand new A321? So I think about the cabin experience when I'm on a longer flight rather than the price, because I think it truly matters. If you're flying older 757s, 67s, whether coast to coast or into the Atlantic market, I think that drives a bigger difference for me than actually what kind of cabin you're flying.
Absolutely encyclopedic. We thank you so much. Of course, that is Jefferies Managing Director of U.S. Equity Research, Sheila Kahyaoglu. Sorry about that. I know, we both have difficult names, so we can bond over that. Now, coming up, we're going to talk more markets. Of course, before we let you go to break, we want to just bring you some breaking news as well. We have also some news in the M&A world. We have that the legendary group, we have the studio run by Thomas Tull here, is pursuing an acquisition. We'll bring you more details on that next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. Earlier today, I was able to speak with Nouriel Roubini, chairman and CEO of Roubini Macro Associates, the famed economist who earned the nickname Dr. Doom for his predictions tied to the global financial crisis. We asked him about the U.S. election and who might be better for the economy.
Their economic policies are going to be very different. If you take at face value what Donald Trump says, he says they're going to impose tariffs of 10% to up to 20% on all imports in the United States. He wants to impose tariffs up to 60% on China. He wants to weaken the value of the dollar because he thinks it's overvalued and is leading to deindustrialization. He wants a looser monetary and credit policy. And the Center for Responsible Budget just 2 days ago said that this fiscal policy, including making permanent all the tax cuts, are going to cost us another $7.5 trillion over the next decade. Those of Harris, 3.5, both of them larger deficit, but certainly much larger. On top of it, he wants to restrict migration, and we know that migration in the U.S. has kept a lead on wage growth and has increased the supply of labor and maintained growth above average. So the combination of all these policies, currency, tariff, monetary, fiscal, and immigration, implies somehow higher inflation and somehow lower economic growth. In that sense, they would be stagflationary.
When I listen to his defense or, Jason Trenner, Joe Livornia defending his policies, they say, look.
Scott Bessent, John Paulson.
Exactly. Yeah. And there's a pretty long list. And they say, look, first of all, don't take what he says at face value, right? Which I guess is a little bit difficult. But they do say that if you drive up those tariffs, you'll have more onshoring of manufacturing, right? Also, if you get tax cuts, there's kind of a Laffer curve argument that we'll take that money that we didn't give to Uncle Sam and spend it out into the economy. They're basically saying they're going to push growth. Why don't you buy that?
Well, I don't buy that because, first of all, if you're going to impose tariffs, increases inflation. And if you're not going to import the goods from China because there are 60% tariffs, low value added or even medium value added labor intensive goods are going to go to Vietnam, they're going to go to Bangladesh, they're going to go to Turkey, to Mexico. The idea we're going to reshore low value added manufacturing in the US just doesn't make any sense. So it'll be just a transfer from China to somewhere else. It's true that he's making the argument that making the tax cuts permanent are going to help economic growth. He wants to massively deregulate the economy, and he wants actually to move away from a green transition to phasing out those IRA subsidies and going back to massive increases in fossil fuel production. It says 3 million barrels a day of more production over the next 4 years. But the reality is that deregulation doesn't have a very large impact on economic growth, maybe 5-10 basis points, but not more than that. We know that tariffs have a negative impact.
That was Nouriel Roubini, Chairman and CEO of Roubini Macro Associates. And before we let you go, check on the markets here because, of course, we've had a pretty flat day there in the S&P 500, but extending losses now down more than 0.2 or nearly 0.2%, and same too for the NASDAQ 100. And now you have 2 years now by 399, so big reversal there. That does it for Bloomberg Markets. I'm Sonali Basak, and this is Bloomberg.